As a stock market investor, I want to make a good return, obviously. And one of the ways that I go about doing that is I am very disciplined in the way that I purchase stocks. I make sure that I always analyze the underlying value of that business, the intrinsic value of the business, based on the cash flows that it's likely to produce, and I don't pay too much for the business. I only buy into a particular stock when I think it's worth, say, 100 and I can purchase those shares for 50. It gives me a big margin of safety should I be wrong in my assumptions around the future performance of that business. And if I'm right, it creates the potential for much higher returns than I had initially targeted. Now, the way I have typically managed that in the past is I basically build up a watch list of stocks that I'm really interested in, I understand, and I can calculate the intrinsic value for. And essentially, once I've got all those things put together, it's really just a waiting game. And when those stocks are eventually priced in the stock market at a substantial discount to their underlying intrinsic value, that's when I go ahead and make the investment. Now, one part of the equation when calculating intrinsic value is I have to say explicitly what type of return I want to make. So I have to say that I want to make a 10% return or a 15% return, and that is going to impact the final intrinsic value number that I have come out in my analysis. Now, what if there was a way that instead of me trying to describe what rate of return I want to make, what if there was a way that I could say, okay, if I pay today's market price, what return am I likely to get? Well, luckily there is a way we can do that, and it's something called an internal rate of return or an IRR. It basically says if we lay out cash today to purchase a particular business or a particular stock, what sort of return are we likely to make based on the cash flows of that business? So today I'm going to take you through how I calculate those internal rates of return. I recommend, if you haven't seen it already, to go and check out my intrinsic value updated video, because that will cover a lot of the terms and initial kind of numbers that I'm putting into the spreadsheet that I'm about to show you. But without further ado, let's get straight into it, and I hope you enjoy. Okay, so we're over at the computer now, and for those that have already seen the how to calculate intrinsic value updated video, where we used a spreadsheet template that Monish Prabhai talks through in his book, this particular spreadsheet will look somewhat familiar. I've made some changes because we are calculating a slightly different metric to the present value of future cash flows like we did in that particular example. In this case, we're sort of flipping things around. So in the discounted cash flow video where we calculate intrinsic value, basically what we do is we look at what are the expected cash flows over a certain period of time, in this case 10 years, that we're expecting to get out of a particular business. And in this example, we're going to use Apple, just like we did in the previous video. And one of the things that you have to do in a discounted cash flow is put in a discount rate, which is essentially your sort of expected rate of return, or what kind of rate of return you want to make. So in the previous video, the example that we used was 10%. So if we want to make a 10% return, then the formulas in the spreadsheet will calculate the price that we would have to pay, assuming all our growth rate assumptions and everything are right. So what we're doing in this example is kind of flipping things around, and instead of calculating the present value of those future cash flows, we're instead looking at, okay, if we pay today's market price, what is the internal rate of return, is the kind of business school term for it. What's basically the return that we're going to make if we pay the market price today? So instead of adding in a return that we want to make, basically we're having this tool calculate it for us. So many of the inputs are going to be the same. I'm going to take you through where I get all the numbers for the spreadsheet, and in this case we're going to use Apple. So firstly, we're going to have to look at how we expect cash flows to grow over the next few years, and the place I like to go to find this is just Yahoo Finance. So if we jump over to Yahoo Finance under Apple and the Analysis tab, then we're able to scroll down and see some analyst expectations for growth. So for the next 5 years, we have an expected growth rate for Apple of 11.48%. I'm just going to use 11.48% just like the analysts have in this example, but in practice, if I was looking to actually analyze a business in quite a lot of detail, then I would base these growth rates off my own research and kind of make my own assumptions on what I think Apple can do. So for years 1 to 5, I'm going to go with 11%. For years 6 to 10, I'm going to be a bit more conservative and go 7%. For the terminal value, so this is basically how much we think we could sell this business for in 10 years. And for most of my analysis work, I basically use a free cash flow multiple of anywhere from 10 to 15. Apple is a fantastic business, so I'm going to use right at the higher end of that range and say that I can sell Apple in the final year for 15 times their year 10 free cash flows. And then I'm going to have to go in and find some actual started numbers to run some calculations for Apple. So the year 1 free cash flow, so to find that, I'm just going to Google Apple free cash flow, and Macro Trends is one of the sites that I like to go to find this stuff. And I'm going to see that in 2019, Apple had a free cash flow of 58.89 billion. So I'm going to go back and add in 58.89 billion. And I will say with Apple, the free cash flow numbers have been relatively consistent over time. What you will want to do in this case is basically try and pick out a representative year of free cash flows. So if you're looking at a business and they had a really unbelievably good year last year, it might be unrealistic to use that as kind of a typical year for the business, and vice versa. If the business went through some kind of event that was really impacting their cash flows, you may want to look at the free cash flow from 2 or 3 years ago, or make some kind of judgment call on what's a realistic kind of typical free cash flow out of that business. So for Apple, we have our 58.89 billion. The other adjustment that we're going to add in is excess capital or cash. So Apple is a business that has a lot of cash on their balance sheet, and we can again find that in Yahoo Finance. So if I go over to statistics, then we should be able to scroll down to the balance sheet, and we'll see that Apple currently has $94.05 billion sitting there in cash. So I'm going to add that into my numbers. The current market cap for Apple, so if you were to theoretically buy the entire business on the public markets today, what would you be paying? Again, we can go back to Yahoo Finance and find that. And we'll see that the market cap is 1.44 trillion. All of the numbers here that basically I'm entering in billion, so this is going to be 1440 billion. And the stock ticker is Apple. So that's got all of the numbers starting to populate in our free cash flow. And basically what this column is representing is when we invest in a business, we're laying out a certain amount of money today, and we're getting cash back as a return in the future. So in this case, in year 0, we are laying out $1,346 billion basically to buy Apple. And the way I'm coming up with that number is basically we're sort of running the numbers as if we were going to buy the whole business here. So for starters, we've got 1440 billion, 1.44 trillion as the market cap that we're paying for Apple. But right off the bat, Apple has cash already sitting there in their bank accounts. So what I'm doing as our effective purchase price is simply 1440 minus 94, which you'll see as a little formula in here. So effectively the price that we're paying is 1346 billion. And that's in here as a negative number because that is a negative sort of cash flow. We're laying out money in order to get some money back from the returns of this business in the future. The next thing we've got is we're starting to project what we think Apple might do in terms of free cash flows out into the future. So we've got our 58 odd billion as our starting point, which is the number that we picked up earlier. And basically we're growing this at 11% per year for the next few years. So from years 1 to 5, it's growing at 11% per year. And for years 6 to 10, it's growing at that 7% per year rate. So those growth rates will have quite an impact on the final number that you get. And in year 10, I've sort of split out a couple of cells on the side here. So in year 10, there are basically two cash flow events. So we get our regular free cash flows, which the business is producing. And again, that's, year 9 cash flows plus an additional 7%, which is our growth rate. And the other event, cash flow event that we get in year 10 is our terminal value. So if we look to sell the business in year 10, we're also going to get some cash inflows from that. And this is where our free cash flow multiple comes in. So this 13 billion or 1.9 trillion is just simply our year 10 free cash flows multiplied by 15 to come up with that number. And this 10th year free cash flow over here is just the sum of those two numbers. So from years 1 to 10, it's simply cash flows from the business. Sorry, 1 to 9, it's cash flows from the business. In year 10, we have cash flows from the business plus a terminal value. Now, the final step to basically figure out what sort of return we're likely to make from investing in Apple at today's prices is to calculate the internal rate of return. And this is relatively straightforward to do in Excel. All you need to do is say equals IRR, open bracket, highlight all the years of free cash flow, including the negative one for when you purchase the stock. That's very important. Close brackets and hit enter. And you'll see that we get an expected return from Apple of 9.24%. Now, it's very important to note here that this 9.24% has zero margin of safety. So stick around for the second half of this video because I'm going to show you a table basically that I've put together which will show you at what sort of expected return I would actually invest in that business. So if I go across to my margin of safety table here, we've got a bit of a table of some of the numbers that I'm typically looking at. So in previous valuation videos, you may have heard me say something along the lines of, I like to value a business and then I will only purchase it if I can get it at a 50% discount. So if I think Apple is worth $1 trillion, just as an example, I will only actually purchase into Apple if I can buy it at half of that or at $500 billion. Now, what we can do is we can take those two metrics. So if I want to make a 10% return with a 50% margin of safety, because we should always have a margin of safety in our analysis, we are very likely that our growth rates and free cash flow projections and so on will be out to at least some extent. So it is very important to always use a margin of safety. And I've put together a bit of a table of, based on what returns you want to make and what particular margin of safety you are comfortable with any given investment, some of the internal rate of return numbers that have to come up. So in my example, most of the time I'm looking for a 10% return on my investments. I want to buy stocks at a 50% margin of safety. So those two parameters combined is equivalent to a 22% internal rate of return. If I can purchase Apple stock when I'm getting a 22% internal rate of return, I'm still very likely to get my 10%, even if the business doesn't perform quite as well as I would have thought. And the bonus to that is it gives you a lot of downside protection, but it also gives you a lot of potential for more upside, because if I am right on the business and Apple does perform as I expect, there's a good chance that I can earn north of 20% a year on that particular investment. So if we go back to our Apple analysis, we've got an expected internal rate of return of about 9.2% at the moment with no margin of safety. So for me to purchase into Apple, I would want to see that number closer to more like 22%. and I know that's going to narrow the whole world of businesses down quite substantially, but that's the way I like to tackle it. It makes me feel much more comfortable when I've got a big buffer and a lot of room to basically be wrong in my analysis, because the internal rate of return or the margin of safety is so substantial that it really protects me as an investor. Now, one of the things you may have heard me talk about in previous videos is something called enterprise value. So I'm not going to go through this in a huge amount of detail in today's video. If you're really interested in my thoughts on when to use enterprise value and when not to use enterprise value, I would definitely check out my intrinsic value updated video to get a feel for that. But basically, I'm going to upload the spreadsheet onto Dropbox so that if you're interested in having a look at it, you can. And I'm going to use an enterprise value version of the spreadsheet there. So basically, very quickly, the advantages of using enterprise value rather than market cap are essentially that you don't have to manually account for the debt and the cash in the business. So if you're looking at a company that has a lot of debt, that debt is going to be captured in the enterprise value figure. So running your numbers off an enterprise value calculation will make a lot of sense. If you're in a business like Apple, where you have not a substantial amount of debt at all and you have bucket loads of cash, a market cap analysis can make a little bit more sense. But most of the time, I am probably using enterprise value, to be perfectly honest. So the process is exactly the same. Enter your growth rates, enter your free cash flow multiple, your year one free cash flow. The only difference really is that there's no need to enter the excess cash that the business has on hand. And instead of using market cap as our starting point, we use enterprise value. Other than that, the analysis is basically exactly the same, so you can tackle it in the same fashion. So there you have it. That's how to calculate an internal rate of return or an expected return if you were to purchase a stock at today's market prices. I hope you enjoyed it, and one of the things I really want to stress that you should be keeping in mind is to always buy with a margin of safety, and don't take that expected rate of return as an absolute given or absolute fact. Things do happen in the business world. Projections don't play out. The vast majority of the time, they don't play out exactly as we initially expected. They may be better, they may be worse, but one way that we can protect ourselves as investors is buying with a margin of safety. In this case, if we have a 10% target return, buying only when the stock is at more like a 20 or 22% internal rate of return gives us a lot of protection in terms of downside, and it gives us a lot more upside than we may have initially had if we pay up too much for the business. So I hope you enjoy. I am going to leave a link down in the description if you want to download the spreadsheet and have a go yourself. But I hope it was useful, and if it was, please hit like, hit subscribe, and I will see you in the next one. Cheers.